Imagine owning a £7 billion empire only to watch it become a debt-ridden ghost of its former self in less than 3 years. In 2021, Morrisons was the crown jewel of British retail, a Big Four giant that owned its own farms, its own factories, and almost all of its own land. But today, that empire is falling apart. It has lost its spot in the top 4, it is drowning in over £5 billion of debt, and it is being forced to sell off the very ground it stands on just to keep the lights on. How did one of Britain's most successful supermarkets destroy its own legacy? Today, Morrisons is fighting for oxygen. Behind the bright aisles and discounted offers is a business drowning in debt, squeezed by inflation and under relentless pressure from rivals who move faster and operate leaner. Sales are slowing, costs are exploding, and the interest payments never stop. Now you might be thinking, supermarkets are boring and safe. People always need food, right? But here is where it gets interesting. Morrisons is not just struggling, it is trapped, almost unable to escape the debt load placed on it in one of the most controversial takeovers in British retail history. This is the story of how a cornerstone of the UK high street ended up on the brink and why survival is no longer guaranteed. Morrisons began in 1899 as a humble market stall in Bradford. By the late 20th century, it had grown into a national powerhouse. Unlike competitors, Morrisons owned much of its supply chain. It processed its own meat, it baked fresh bread in store, it marketed itself as honest British food at fair prices. By 2010, Morrisons generated more than £17 billion in annual revenue. It was profitable, it was conservative, debt levels were manageable. For investors, it was not flashy, but it was dependable. This model worked for decades. While rivals chased efficiency through outsourcing, Morrisons doubled down on control. That control created quality and loyalty, but it also created heavy fixed costs, and those costs would soon become a problem. The peak came just before the world changed. In the late part of that decade, Morrisons operated nearly 500 stores across the UK. It employed around 118,000 people. It owned valuable real estate, distribution centres, and manufacturing assets. Then, in 2021, private equity came knocking. Clayton, Dubilier and Rice acquired Morrisons for around £7 billion. It was one of the largest leveraged buyouts in UK history. On paper, it looked like a vote of confidence. In reality, it changed everything. The deal loaded Morrisons with billions in debt. Interest payments replaced reinvestment. Cash that once went into stores, technology, and price competition now flowed to lenders. At the same time, the grocery industry entered its most brutal period in decades. Inflation exploded, energy prices surged, labor costs climbed, suppliers demanded higher prices, shoppers traded down, buying cheaper brands or switching to discounters like Aldi and Lidl. Morrisons was hit from all sides. Its vertically integrated model meant higher exposure to rising costs. Owning bakeries, abattoirs and factories once provided control. Now it magnified risk. When energy costs rose, Morrisons paid directly. When wages increased, Morrisons paid directly. Meanwhile, rivals moved faster. Aldi and Lidl expanded aggressively with lower prices. Tesco leveraged scale and data. Sainsbury's tightened operations. Morrisons, burdened by debt, had little flexibility. By 2023, reports suggested the company was carrying around £6 billion of debt. Interest rates were no longer near zero. Servicing that debt became dramatically more expensive. Private equity did what private equity always does. Costs were cut, jobs were reduced, assets were sold. Some manufacturing operations were closed or scaled back. But these cuts risked damaging the very strengths that once made Morrisons different. Fresh food counters disappeared in some stores. Customer experience suffered. Brand loyalty weakened. Sales growth lagged behind competitors. Profit margins thinned further. This is the midpoint twist. Morrisons is not failing because people stopped buying groceries. It is failing because its financial structure no longer matches its business reality. Debt is the cage. Even when operational improvements generate cash, much of it goes to interest payments. Even when prices rise, customers defect to cheaper rivals. Even when costs are cut, inflation eats the gains. In 2024 and 2025, speculation intensified. Analysts questioned whether Morrisons could refinance its debt on favorable terms. Bond markets grew cautious. Credit ratings faced pressure. Some feared asset sales would become forced rather than strategic. Selling property to pay debt may buy time, but it weakens long-term competitiveness. Others warned of a slow bleed, not a sudden collapse, but a gradual decline, store by store, region by region. Management insists the business remains viable. Suppliers continue deliveries. Shelves remain stocked, but viability is not the same as safety. Today, Morrisons stands at a crossroads. It is not bankrupt, but it is fragile. Grocery retail is low margin, highly competitive, and unforgiving. Heavy leverage leaves little room for error. If inflation stays high, if consumers remain price sensitive, and if refinancing costs rise further, Morrisons may find itself unable to escape the cycle. There are only a few possible paths forward. One is a major restructuring, debt renegotiation, asset disposals, and real reinvestment. Another is a merger or breakup, selling parts of the business to stronger players. The darkest path is administration, a word no one wants to hear, but one that has already visited other British retailers once considered untouchable. So what does the Morrisons story really tell us? It tells us that even essential businesses are not immune to financial engineering gone wrong. It tells us that debt can turn stability into vulnerability, and that in modern capitalism, ownership matters as much as operations. Morrisons did not suddenly forget how to sell food. It did not lose all its customers overnight. It was changed by a deal that prioritized short-term returns over long-term resilience. For employees, the stakes are personal. Jobs, pensions, and communities hang in the balance. For shoppers, it is a warning. Cheap prices often come with hidden costs. And for the British High Street, Morrisons is another symbol of transition. From family-owned businesses to global finance, from patience to pressure, the lights are still on, the doors are still open, but the clock is ticking. Because in the supermarket business, margins are thin, competition is brutal, and debt never sleeps. And Morrisons is running out of room to breathe. If you want to see more business breakdowns like this, make sure to like and subscribe.